A pleasant day to everyone. I am Nathaniel ANDALES from Group 2, and we are going to discuss about internal rules, ownerships, and transactions, focusing on bylaws, meetings, stock and stockholders, corporate books and records, mergers and consolidation, and appraisal rights. And now, let's start with Title 5, focusing on bylaws. And it has three sections, from section 45 to 47. The first section that I'm going to discuss is section 45. It is about the adoption of bylaws. But before that, I'm going to explain first what is bylaws. Bylaws are the rules that tells what the company should do and how the company should be run. Some of the things bylaws tells are how and when the meeting will happen, who can make decisions, what are the duties of the officers inside and outside the company, and how members and stockholders should act. And there are many more. And now, I'm going to discuss the section 45. This section explains how a corporation officially creates and approves its bylaws or the rules for running the company. A corporation officially creates bylaws with some steps. First is who approves the bylaws. The bylaws approves by the stockholders or members. Most of them must agree to approve the bylaws. Second is where the bylaws should be kept. The bylaws must be kept in the main office and can be checked during office hours. Third is filing with the Securities and Exchange Commission or SEC. The certified copy that is signed by the company officers must be sent to the Securities and Exchange Commission or SEC. Fourth is when bylaws can be made. Sometimes bylaws can be made before the company is officially formed, but they must still be approved by the Security and Exchange Commission or SEC. And lastly, when the bylaws become effective. The bylaws will only take effect after the SEC approves them. And now let's proceed to section 46. It is about the contents of bylaws. This section explains what can be written inside the bylaws. The bylaws can include rules about when, where, and how meetings will happen, how to call special meetings and inform members, the number of people needed to make decisions or called a quorum, how members or directors can vote, the use of proxies or someone voting for another person, the qualifications, duties, and pay of directors or officers. Next is when to hold the annual meeting. Next is how to elect or appoint officers, penalties for breaking the bylaws, how to issue stock certificates, other rules needed for the company's smooth and honest operation, and also they can include an arbitration agreement or a way to solve conflicts peacefully. And let's proceed to section 47. It is about the amendment to bylaws. This section tells how to change or update the bylaws. A majority of the board and a majority of stockholders or members can change or make new bylaws. The owners of two-thirds of the capital stock or members can also give the board the power to change the bylaws for them. And if this power is given but later the majority wants to take it back, they can revoke or cancel it in another meeting. And after any change, the company must file the new bylaws with the Security of Exchange Commission or SEC for approval. And the change will only take effect after the SEC approves them. And that's the end of Title 5, focusing on bylaws. And now let's proceed to Title 6, focusing on meetings. And it has 11 sections from section 48 to 58. And now let's begin to section 48. It focuses to the kinds of meetings. This section explains the types of meetings that a company can have. Like, meeting can be regular or special. Regular, like it is usually done yearly. And special, it is called for a specific reason. And these meetings includes directors, trustees, stockholders, or members. And that's the end for section 48. For the section 49 and above, my group mates will discuss them.
Good day everyone, my name is Chaze. By POLO, I will discuss about Title 6, Section 49 to 52. In Section 49, we have regular and special meetings. In regular meetings must be held annually, either on a fixed date in the bylaws, or if not fixed, any date after April 15, as set by the board. Notice requirement: written notice for regular meetings must be sent to all stockholders of record at least 21 days before meetings. This ensures everyone is fully informed. The notice can be sent via mail or other means the Commission allows. Next, we have two related but essential administrative points from our materials. Closing the books to determine who is eligible to vote. The stock and transfer book must be closed before the meeting. For regular meetings, it must be closed at least 20 days prior, and for special meetings, 7 days prior. Postponement notice: if a regular meeting is postponed, written notice of the new date, and the reason for the postponement must be sent to all stockholders of record at least 2 weeks prior to the new meeting's date. This ensures transparency when things change. Now, let's look at voting rights. The right to vote can be exercised in person, through a proxy, or if the bylaws allow, through remote communication or in absentia. This is a modern flexibility that facilitates broader participation. In Section 50, we have place, time, and agenda requirements. Meetings must be held at the stated date and appointed time as per the bylaws. They must take place in the principal office of the corporation unless otherwise stated in the Articles of Incorporation. Every notice of a meeting must be accompanied by the following documents. First, the agenda of the meeting. Second, the proxy form for those who cannot attend. Third, details on how remote participation and voting will be allowed. And lastly, for election of directors or trustee, the requirements and procedure for nomination and election must also be included. Section 51 and 52, we have quorum, the essence of validity. The most crucial concept for a meeting's validity is covered in Section 51. Quorum in meetings. Quorum is the minimum number of members who must be present for any valid business to be transacted. For stock corporation, the quorum is generally based on the number of outstanding voting rights. Unless the code of the bylaws provides otherwise, the quorum must be a majority of the outstanding voting stock or voting members. For non-stock corporation, only actual living members with voting rights shall be counted toward the quorum. The rules are strict. Dead members shall not be counted. Lastly, Section 52 briefly touches upon the quorum for the board directors and trustee. Similar to the general rule, the quorum is typically the majority of the number of directors or trustee, as specified in the Article of Incorporation. And that's all. Thank you.
Hello everyone, I'm Denzelle Raine as FRIAS, and I will be explaining Section 53 to Section 56 of the Republic Act Number 11232, also known as the Revised Corporation Code of the Philippines. Section 53. Who shall preside at meetings? At any formal corporate meeting, one person must officially preside. But who gets that authority? The Revised Corporation Code provides a clear default hierarchy. By law, the chairman is designated to preside at all meetings of the directors or trustees, as well as the meetings of the stockholders or members. In the chairman's absence, the authority passes to the president, who then presides over the meeting. However, the default rule is not absolute. The law includes a critical exception. unless the bylaws provide otherwise. This means a corporation's own bylaws have the final say. The bylaws can override the default and designate a different officer, establish a different order, or set unique rules for who presides. Section 54. Right to vote of secured creditors and administrators. A stockholder's right to vote is fundamental. But what happens when shares are pledged for a loan, or when the stockholders passes away? Section 54 of the Revised Corporation Code addresses this clearly. First, let's discuss secured creditors. By default, if you pledge your shares as collateral for a loan, you, the stockholder grantor, keep your rights to vote at meetings. The creditor can only vote those shares if two specific conditions are met. The right expressly given in writing by the stockholder, and the agreement is recorded in the appropriate corporate books. If either step is missed, the vote stays with the stockholder. The second part of Section 54 deals with the legal representatives. If a stockholder is deceased or incapacitated, their court-appointed representatives, like executors, administrators, or receivers, may attend and vote on their behalf. Crucially, these legal representatives do not need a separate written proxy. Their court appointment is their authority to vote. Section 55. Voting in case of joint ownership of stock. When two or more people own the same shares, how do they vote? Does one person decide, or must they all agree? Section 55 of the Revised Corporation Code sets two different rules. First, the general rule. If shares are owned jointly, like Maria Cruz and Jose Reyes, the law requires anonymous consent. To vote those shares, all co-owners must agree. If one of them disagrees, the shares cannot be voted. The only way around this is if all co-owners sign a single written proxy, authorizing one person to vote for the group. However, the law provides a crucial exception for shares owned in an and/or capacity. For example, the shares are registered to Maria Cruz and/or Jose Reyes. The rule changes completely. Any one of the owners can vote the shares or appoint a proxy without needing the consent of the other. So in joint ownership, the capacity is the key and requires unity and/or grants individual authority. Section 56. Voting rights for treasury shares. If a corporation buys back its own stock, can it vote those shares at the annual stockholders meeting? The Revised Corporation Code is very clear on this. Section 56 states that treasury shares shall have no voting rights as long as they remain in the treasury. So what are treasury shares? These are shares that the corporation first issued to the public. Then the corporation bought back or reacquired those same shares. While the corporation holds them, they are kept in its treasury. The logic is simple. First, a corporation cannot legally be its own shareholder. Second, this rule prevents a major conflict of interest. If a company could vote its own shares, The people in charge could use corporate money to buy stock just to vote for themselves, silencing the other stockholders. The law makes these shares silent to protect the rights of all other investors. This loss of rights is only temporary. If the corporation reissues or sells those treasury shares to the public, the shares are no longer in the treasury. Their voting rights are immediately restored, and the new owner can vote them.
Good day, everyone. My name is Shanen TUTOL, a student of Management Accounting. To begin with, this report aims to elucidate the provisions of Title 6, Section 57 and 58 concerning internal rules, ownership, and transactions with a focused discussion on the regulations governing meetings. So let's proceed to Section 57. Treasury shares. What is treasury shares? Treasury shares are shares that bought back by the corporation and keeps it in its treasury. Because the company already owns these shares, they don't have voting rights. Why is that? Because this is to prevent the company from using its own shares to influence the decision. So, let me give you an illustration. Imagine the students are the real stockholders and the return cards are the treasury shares. One day, Mrs. Ramirez class is voting on what the next class activity should be. So each student has their own voting cards. But before the voting day, there are 5 students who transferred to another school and returned to Mrs. Ramirez their own voting card. So Mrs. Ramirez has extra 5 voting cards and keep it in her drawer. On the voting day, Mrs. Ramirez asked the students, who wants to vote for a movie day? Absolutely all the kids raised their hands because they all want the movie day. But Mrs. Ramirez joked around and pulled out her 5 extra voting cards and wave it in the air and says, these cards are for your extra homeworks. So the whole class shouted, no, Mrs. Ramirez, you cannot use those cards. The students are gone. They don't count anymore. And Mrs. Ramirez laughed and says exactly that this voting cards has no voting power. So, to, as you can see, this illustration shows how treasury shares works. So if Mrs. Ramirez could use those voting cards, that wouldn't be fair for the students because she could control the vote and the decisions inside the class. And that's how treasury shares works. To continue, we will move forward to Title 6, Section 58, wherein it specifically tackles the rules on proxy, including the requirements for a proxy to be valid. So let's begin with Section 58. What is proxy? A proxy is someone who is authorized to vote on behalf of the stockholders or member. If a stockholders can attend the meeting, they can give another person the power to vote for them. For a proxy to be valid, of course, he or she needs to meet the requirements. Number 1, it must be in writing and signed by the stockholders. Number 2, it must be filed with the corporate secretary before the meeting. Number 3, it is normally valid only for meeting as stated in the documents unless it says otherwise. And lastly, number 4, Even if it is continuing proxy, it cannot be effective more than 5 years. So remember, as stockholders may vote personally or through proxy. So let me give you another illustration again. So Luna owns shares in Sunrise Company. She wants to vote in the upcoming stockholders meeting, but she will be out of them. So she writes and signs a simple letter saying, I authorize, for example, Marco. I authorize Marco to vote on my behalf in June 10 meeting. Now, Marco becomes her proxy and can vote on her behalf. So that's how proxy works in the company. Moving forward to Title 7, Section 59 and 60, which pertains to internal rules, ownership, and transaction with a specific focus on stocks and stockholders. These sections will discuss the regulations governing share issuance, transfer, and the rights of the shareholders, providing a comprehensive analysis of their impact on corporate governance. So let's discuss first Section 59, the voting trust. What is a voting trust? A voting trust is an agreement wherein stockholders temporarily give their voting rights over their shares to a trustee. What is a trustee? A trustee is the one who vote and exercise related rights for a set of period, usually up to 5 years, unless it is required for a loan, in which case it may be longer but ends once the loan is paid. To be valid, a voting trust must follow these rules. Basic requirements. Number 1, written and notarized agreement, of course. Number 2, certified copy must be filed with the corporation and the SEC. Number 3, the original stock certificate are canceled and new stock certificate are issued in the trustee's name. Number 4, the trustee gives the shareholders the voting trust certificate as a proof of ownership, but not the voting power. Number 5, the agreement must not be used for fraud or to break anti-monopoly laws. Number 6, the trust agreement can be inspected like other corporate records. So, other share stockholders may join the trust under the same terms. When the voting trust period ends, the trustee certificates are automatically canceled. New stock certificates are returned to the original stockholders, and all rights go back to the stockholders. So, voting trust is picking a responsible person to vote on your behalf. That's how voting trust works. So, let's proceed to Title 7, Section 60, Subscription Contract. What is a subscription contract? A subscription is a contract to buy and issue shares of a corporation, existing or still to be formed. Even if you call it a purchase or something else, it's still a subscription. So I will tell you how a person becomes a shareholder. Number 1, subscribe to an issued shares, wherein you will sign a subscription contract with the corporation. Number 2, buy treasury shares, wherein you will buy shares the corporation previously issued but later reacquired. Number 3, acquired shares from another person, wherein you will buy or receive shares already owned by the stockholder. So, when is a person considered a stockholder? A person becomes a stockholder when there is a valid contract, of course, even if it's not written, such as when someone accepts a stock certificate, attend meetings as a stockholder, pays for shares, and SEC approval. So a corporation must get approval from the SEC before selling the shares to the public unless exempt. So, who issues shares? The board of directors decide the issuance of shares, not the stockholders. So let me tell you different kinds of subscription. So number one, the pre-incorporation. Here, they will agree before the corporation is formed. Before. And number two, post-incorporation. Here, they will agree after the corporation already exists. Number three, absolute subscription. Here, there is no conditions attached. Number four, conditional subscription. Here, they are only valid if a certain event happens. And lastly, the subscription on special terms. The subscription on special terms, here the corporation promises to do something, but it is not a condition for becoming a stockholder. So let me give you an illustration for you to understand more how to become a stockholder. So Anna wants to become part of Sunshine Cafe Corporation. So a while ago, we talked about how a person becomes a shareholder. So number one, subscription. So before the corporation is formed, Anna signed a contract promising to buy 100 shares. So this subscription is what you call pre-incorporation subscription, because a while ago we talked about different kinds of subscription. It is agreed before the corporation is formed. So it is a pre-incorporation. Number two, buying treasury shares. So Ben buys 50 treasury shares. The company had these shares because someone returned them earlier. So we talked about that a while ago in section 57. So number three, transferring shares. And Carla sells her 10 shares to Daniel. So Daniel becomes the new owner. So this how subscription contract works.
Good day everyone, my name is Harold P. PALAPAG, and next I'll be discussing Section 61 to 64 of Title 7 under the Revised Corporation Code of the Philippines. These sections talk about the rules of issuing stocks, transferring them, and the responsibilities of directors and stockholders. Now let's start with Section 61. Section 61, Consideration for Stocks. Stocks can only be issued if they are fully paid with a valid consideration, meaning something of the real value. The law allows several forms of payment such as actual cash, properties that's useful for the corporation, labor or services rendered, debt previously owed to the company, or shares exchanged from the other corporations. But remember, a promissory notes or future services are not allowed at payment for shares. If payment is not in cash, or the value must be fairly determined by the board of or the stockholders and reported to this SEC. In short, stocks must be always be issued for real value or never for promises. Next, Section 62. certificates of stocks, and transfer of shares. This section explains how stocks are documented and transferred. Each stock must have a certificate signed by corporate officers and sealed with the company seal. Stocks are personal property, which means they can be sold or transferred, but it's only valid if the transfer is recorded in the corporate's book. The SEC may also require some corporations, especially the public ones, to issue electronic or scriptless shares. However, if a stockholder still owes money to the corporation, their shares cannot be transferred until the debt is paid. Next, Section 63. Issuance of stock certificates. This one is short and simple. No certificates of stocks will be issued unless the subscription is fully paid. That includes the full amount plus any interest or charges due. In other words, no full payment, no stock certificate. Next is Section 64. Section 64 is liability of directors for watered stocks. Now, what are watered stocks? These stocks are issued for less than their par value or issued value. If a director or officer approves or allows the issuance of watered stocks or knowingly stays silent about it, they are personally and solidarily liable with the stockholder. They must pay the difference between the real value received and the par value or issued value. This ensures that directors act responsibly and honestly in valuing shares. So these sections protect both the corporations and its investors by ensuring fairness, accountability, and transparency in issuing and handling shares. That's all. Thank you.
Section 65. Interest on unpaid subscription. This section means that if a person agrees to buy share of a company but has not fully paid for them, they are required to pay interest on the remaining unpaid balance. This interest begins to accumulate from the date they made the agreement, also known as the date of subscription. The amount of interest they need to pay depends on what is written in the subscription contract. If the contract specifies an interest rate, the rate will be followed. However, if the contract does not mention any rate, the law provides a standard of legal interest rate that will automatically apply. This rule ensures fairness by encouraging subscribers to pay their share on time and protecting the corporation from financial loss due to delayed payments. Section 66. Payment of balance of subscription. This section means that the board of directors has the power to require stock subscriber to pay the remaining balance of their share whenever needed, along with any interest that has accumulated. The subscriber must pay either on the date agreed upon in the subscription contract or on the new data set by the board of directors. If the subscriber fails to pay on time, the entire remaining balance automatically becomes due immediately, and interest will continue to be added until the full amount is paid. If the subscriber still does not pay within 30 days after the due date, their share become deliquid. This means the corporation has the right to take action by selling those shares, usually through a public auction, to recover the unpaid amount, unless the board of directors chooses a different course of action. This rule ensures that shareholders fulfill their financial obligation and protects the corporation from losses caused by unpaid subscription. Section 67. Delinquency sale. This section means that if a stockholder fails to pay the remaining balance for their subscribed share, the board of directors can order the sale of those delinquent shares through a formal resolution that state the amount owed, including interest and sales expense, and set the date, time, and place of the sale within 30 to 60 days. After the share becomes delinquent, the stockholder must be notified personally by registered mail or by other allowed means. And the sale notice must be also be published weekly for 2 consecutive weeks in a newspaper where the corporation main office is located. If the stockholder pays the full amount before the sale, they can keep their share. Otherwise, the share will auction to the bidder who offers to pay the total balance for the smallest number of shares, and any remaining shares will still belong to the stockholder. If no one bids at the auction, the corporation can take ownership of the share as their treasury share, and which it may later sell or use according to corporate law. Section 68. When sale may be questioned. This section means that if a stockholder believes that there was an error or irregularity in the sale of their delinquent shares, such as mistake in the notice given or in how the sale was conducted, they cannot immediately challenge or recover their share without first paying or at least offering to pay the amount for which their stock was sold, along with the legal interest calculated from the date of the sale. This rule ensures fairness to the person or corporation who bought the share and prevents baseless complaints. Additionally, the law set a strict time limit. The stockholder must be filed their complaint within 6 months from the date that the sale took place. If they fail to do so within the period, they lost the right to question or recover the sold share permanently.
And now, let's proceed to Section 69, Create the action to recover unpaid subscription. In this section, it states that if someone subscribes to buy shares in a company but doesn't pay for them, the company can take legal action to collect the payment. It's like if you promise to buy a phone on installment but stop paying for it. Then the seller can sue you to collect what you owe. Similarly, the corporation can also go to court to demand payment for unpaid shares, along with any accrued interest and expenses associated with collecting them. Section 70, Effect of Delinquency. Section 70 tells us what happens when a stockholder doesn't pay on time. Their shares become delinquent. And once that happens, that person either can vote, can't attend, or be represented at stockholder meetings, and also can't exercise the most stockholder rights. But there's one exception. They may still get dividends, depending on the rules in the code. So just imagine, you subscribe to 100 shares worth 1,000 pesos each, but only paid half and missed the deadline for the rest. Until you settle the remaining balance, you can't receive most benefits, and you also cannot vote in company meetings. Basically, if you owe money on your shares, you lose your privileges as a stockholder until you pay what you owe, including the interest and any costs. Section 71, Rights of Unpaid Shares or Non-Delinquent. In Section 71, it explains that all unpaid shares are delinquent. If you're still paying on time or within the agreed schedule, you still have full stockholder rights, like voting, receiving dividends, and joining meetings. You only lose those rights when you become delinquent or past due. So for example, let's say you agreed to pay for your shares in 3 monthly installments and you've only paid the first one. As long as you're not late with the next payments, you can still vote and join meetings. And for the last section of Title 7, Section 72, Lost or Destroyed Certificates. This section explains what to do or what the steps are if a stock certificate or proof of ownership is lost, stolen, or destroyed. First, the registered owner should file an affidavit with the company explaining what happened and give the details about the lost certificate, how the certificate was lost, stolen, or destroyed. Next, the company should check its record and then publish a notice in a newspaper once a week for 2 weeks at the expense of the registered owner, so the public is aware The notice shall state the name of the corporation, the name of the owner, the serial number of the certificate, and the number of shares represented by such certificate. If no one contests the claim after 1 year, the company can cancel the old certificate and issue a new one. But if the owner files a bond like a financial guarantee, the company can issue the new certificate even before the 1 year period. And if someone contests the ownership or there's a court case, the company waits for the court's final decision. Also, the law protects the company as long as it follows the procedure properly. It can be sued later for issuing the replacement certificate. Let's say Maria's stock certificate for 500 shares got burned out in a house fire. She files an affidavit and the company publishes like a notice. After a year with no objections, she gets a new certificate, but if she provides a bond, she could get it sooner. And here are some key takeaways from Section 69 to 72. Corporation can recover unpaid subscriptions through the courts. Delinquent stock loses voting and stockholder rights, except for dividends. And for non-delinquent, unpaid shares retain their full rights. And lastly, clear procedures exist for lost, stolen, or destroyed certificates, protecting both the shareholder and the corporation. And for the last section of Title 7, Section 72, Lost or Destroyed Certificates. This section explains what to do or what the steps are if a stock certificate or proof of ownership is lost, stolen, or destroyed. First, the registered owner should file an affidavit with the company explaining what happened and give the details about the lost certificate, how the certificate was lost, stolen, or destroyed. Next, the company should check its record and then publish a notice in a newspaper once a week for 3 weeks at the expense of the registered owner, so the public is aware. The notice shall state the name of the corporation, the name of the owner, the serial number of the certificate, and the number of shares represented by such certificate. If no one contests the claim after 1 year, the company can cancel the old certificate and issue a new one. But if the owner files a bond like a financial guarantee, the company can issue the new certificate even before the 1 year period. And if someone contests the ownership or there's a court case, the company waits for the court's final decision. Also, the law protects the company as long as it follows the procedure properly. It can be sued later for issuing the replacement certificate. Let's say Maria's stock certificate for 500 shares got burned out in a house fire. She files an affidavit and the company publishes like a notice. After a year with no objections, she gets a new certificate, but if she provides a bond, she could get it sooner.
Good day, my name is RM John A. TORREVERDE, and right now we are diving into two fundamental titles of the revised Corporation Code of the Philippines. Titles number 8 on Corporate Books and Records, and Title number 9 on Merger and Consolidation. These provisions are crucial for understanding corporate governance, shareholder rights, and major corporate restructuring. According to the Section 73 of the Title 8, the mandatory records, every corporation is strictly required to keep and preserve a comprehensive set of documents at its principal office. The law demands transparency and a clear paper trail. This set of records and documents includes number 1, organizational data. These are the articles of incorporation, bylaws, and all amendments. Number 2 is the ownership and control. This is critical, guys. Corporation must detail the current ownership structure, voting rights, list of stockholders and members, and all beneficial ownership information. Number 3 is the governance. These are the names and addresses of all directors, trustees, and executive officers. Number 4, the operational history of the corporation. These are the record of all business transactions and all resolutions passed by the board and all stockholders or members. And last but not the least, the minutes. Detailed minutes of all meetings, capturing not just the actions taken, but also who was present or absent, and if demanded, the specific yeas and nays of any motion. Under this section is also the right to inspection. The law empowers certain stakeholders with the right to inspect these records. Now, the questions are, who are these individuals and when do they usually inspect or when do they must inspect those documents? To answer those questions, those are any directors, trustees, stockholders, or member, or even the representatives. And they are inspecting those documents during reasonable hours on business days, and they can also make a written demand for copies at their expense. However, this right is not absolute. The inspecting party is bound by confidentiality rules, protecting things like trade secrets under the IP Code of the Philippines and personal data under the Data Privacy Act of the Philippines. Now, there is a crucial limitation. The right to inspect is denied to any person who is a competitor or someone who represents the interests of a competitor, or who is deemed to be acting in bad faith or for an illegitimate purpose. The code imposes severe penalties to ensure compliance. These are the conditions. Number 1. An officer or agent who unlawfully refuses inspection is liable for damages and an offense under the code. Number 2. If the refusal is based on a board resolution, the directors who voted for the refusal bear the liability. Number 3. If the inspection is denied, the aggrieved party can report to the SEC, which is required to conduct a summary investigation and issue an inspection order within 5 days. And under this title, section number 74, regarding to financial reporting, a corporation must furnish its most recent financial statement to a requesting stockholder or member within 10 days of a written request. And financial reports must be presented at the regular meeting, noting the certification rule. If a total assets or liabilities are less than 600,000, the statements can be certified only by a treasurer and the president under oath. Let us move on to the next title. Title number 9, Merger and Consolidation, Section 75 and 76. This title deals with the formal process of combining two or more corporations. This means that one corporation stands and one or more corporations is absorbed to that one corporation. According to Section 75, Plan of Merger or Consolidation, the process starts with the board of directors or trustees of each constituent corporation. They must approve a plan of merger or consolidation that clearly sets forth, number 1, the names of the constituent corporations, number 2, the terms of the merger or consolidation, and the mode of implementation, number 3, the changes to the articles of the surviving corporation for merger, or the complete new articles for consolidation. Now, the word approval is only the first step. The plan must be then ratified by the corporate owners at separate meetings. And under the Section 76 are the stockholders or members' approval. There is a required vote to come to a specific decision. An affirmative vote of stockholders representing at least 2/3 of the outstanding capital stock or 2/3 of the members is required from each constituent corporation. Now, we have the so-called power of dissent. This massive vote requirement is balanced by the right of appraisal. Any stockholders who dissents or votes against the merger has the right to demand that the corporation buy back their shares at fair value. This is a critical protection for minority rights. And under this, we have the amendment rule. Any amendment to the plan also requires the 2/3 ratification vote.
Good day everyone, I am Honey-Mae MALTO. This is the continuation of Title 9, Merger and Consolidation. In Section 77 talks about the articles of merge or consolidation. Once the stockholders or members of the corporation involved have approved the merge or consolidation, both corporations must execute official articles of merger and consolidation. These documents are signed by the President or Vice President and certified by the Secretary of each corporation. This article must include several important details: the complete plan of merge or consolidation, the number of shares or members involved, the voting results, how many voted for or against the plan, the carrying amounts and fair values of assets and liabilities, the accounting method to be used, the provisional or pro forma values after merging, and lastly, any additional information required by the Security of Exchange Commission or SCA. Moving on to Section 78, Effectivity of Merger or Consolidation. After the articles are signed and certified, they must be submitted to the SEC for approval. However, if the merger involves banks, schools, insurance companies, or other corporations under special laws, a favorable recommendation from the concerned government agency is first required. Once the SCE is satisfied that the merger or consolidation complies with the law, it issues a certificate of approval, and from that moment, the merger or consolidation officially takes effect. But if the SEC finds any inconsistency or in violation of the law, it will set a hearing to allow the corporation to present their side before making a final decision. Next, Section 79, Effects of Merge or Consolidation. When a merger or consolidation takes effect, first, the corporation involved become one single corporation. In a merger, the surviving corporation continues to exist. In a consolidation, a new corporation is formed. Second is the separate existence of the other corporation ceases. And the surviving consolidated corporation automatically inherits all the rights, privilege, properties, receivables, and obligation of the old corporation. All pending cases or claims may continue under the name of the surviving or new corporation. Most importantly, the rights of the creditors remain protected and unaffected. Now, we proceed to Title 10, Appraisal Right, under Section 80. This section gives stockholders the right to dissent, meaning they may disagree with certain corporate actions and instant demand payment of the fair value of their shares. This right may be exercised in the following cases. First is when there's an amendment to the articles of incorporation that changes or limits stockholders' right, when there's a sale or disposition of all or substantially all of the company's assets, when there is a merger or consolidation, or when the corporation invested in funds in a purpose other than its primary business purpose. This provision protects minority stockholders from being forced into decisions they do not agree with, ensuring fairness and balance in corporate actions.
Good day, everyone. So today we'll discuss one of the most important safeguards for minority stockholders in a corporation, the appraisal right, as provided under Section 81 to 85 of the Corporation Code. What is the appraisal right? So the appraisal right gives a stockholder who disagrees with certain major corporation actions the right to demand the corporation to buy back his shares at their fair value. It's a form of protection allowing a dissenting shareholder to withdraw from the corporation and get fair compensation, instead of being forced to go along with decisions he doesn't agree with. This right is not exclusive, meaning it can be exercised alongside other remedies available under the law. So when and how it is exercised, a stockholder who voted against a proposed corporate action may exercise the appraisal right by making a written demand within 30 days after the vote. This demand must indicate the intent to be paid the fair value of his shares. If the corporation proceeds with the action despite the objection, the stockholder must surrender his stocks, certificates, and will then be entitled to receive payment once the fair value is determined. However, if the stockholder fails to file within 30 days, his right is deemed waived. So, payment and termination of rights. From the moment the corporation receives the demand, the stockholder loses all his rights, including voting and dividend rights, except the right to payment for his shares. The corporation must pay the fair value of shares within 30 days after the award is finalized. If the stockholder is paid on time, interest accrues. If the corporation and stockholder cannot agree on the fair value, it may be determined through appraisers appointed by both parties. So when the right ceases or is withdrawn, there are situations when the appraisal right ceases to exist. So these appraisals are if the corporate action is abandoned or rescinded, if the SEC disapproves the action, if the stockholder withdraws his demands with the consent of the corporation, or if the stockholder is found not entitled to the right. In such cases, the stockholder's rights as a shareholder are restored as though no appraisal had occurred. So effect on the corporation is refusal to pay. If the corporation refuses or fails to pay within the 30 days, it must restore all the stockholders' rights automatically unless the refusal was justified, such as in cases or insufficient retained earnings. This ensures fairness both ways, protecting the and dissenting the shareholder without unduly burdening the corporation's financial stability. So the ones who bear the cost of appraisals, according to Section 85, the corporation generally bears all costs of the appraisal process, including appraiser's fees, attorney's fees, expert accountant's fees, and witness expenses. However, if the appraised value is roughly the same as the corporation initially offered, or if the stockholder's refusal to accept was unjustified, then the stockholder bears the cost. So, in summary of all that I explained, the appraisal right serves as a protective shield for minority shareholders, ensuring that their interests are respected when major changes occur in the corporation. It gives them the freedom to opt out with fair value instead of being bound by the decisions they do not support. At the same time, it maintains balance by ensuring that corporations are not unduly penalized when acting in good faith. So, appraisal rights is not just a financial mechanism, it is a principle, fairness, and corporate democracy, giving every shareholder a voice and an exit when the majority's decision no longer aligns with their interests.